You account for all of those unrecoverable costs that the owner has. You account for the renter investing in the stock market and investing the cost difference, the cash flow cost difference between renting and owning each month or whatever frequency. And what you'll find, and I've done this with projections, so looking at expected stock returns and expected real estate appreciation, you can very easily show that there is unequivalence. There is a level of rent where you are indifferent between renting and owning. Okay, if you divide the price of a home by 5% and then divide that number by 12, you will get the monthly rent that is equivalent to the unrecoverable cost of owning that home.
Okay, so let's do that. So I'm thinking of buying a $300,000 house. What's the math that I need to do to figure out if it's better to rent?
Multiply by 5% and then divide that by 12.
Okay, the result is 1,250.
There you go. 1,250 is the equivalent rent where you're roughly break even between renting and owning.
So if I could rent for 1,250 instead,
or less,
I should rent.
Renting is a better financial decision. So this is an important part of this topic. We can show financial equivalence, and just that is important. Like, we can show that there is financial equivalence between renting and owning. I've done more robust versions of this analysis since then. PWL has a calculator on our website where you can see the break even by putting specific numbers in instead of just doing the rough rule of thumb, because things will change it. For example, if your asset allocation is more conservative or more aggressive, that opportunity cost number can be different. If you're a taxable investor, meaning that you're taxed on your investment gains by investing in the stock market or the bond market, your opportunity cost decreases because the after-tax expected return on stocks and bonds decreases relative to home ownership. 5% is a very rough rule of thumb.